Commercial real estate feels like it's always on the brink these days. From mass defaults to empty offices to bank meltdowns to this dreaded wall of maturities. It's been overwhelming how much there is to absorb. And then there's all these acronyms that make it feel like a secret code language. With a troubled market comes greater need for knowledge. So I thought it'd be good to break down some of the key commercial real estate acronyms that keep coming up. You ready? Let's break it down. Number 1, CLOs. Collateralized loan obligations, or CLOs, are mortgages packaged into bonds that are sold on to investors. Part of their appeal was that they allowed investors to put down less equity and take on more debt than conventional mortgages. They also typically have shorter loan terms and floating interest rates, which gives owners more flexibility to sell or refinance. Contrast that with your conventional CMBS, which is a fixed rate and generally works better with stable assets, as in assets where the income is pretty much set. These qualities made CLOs all the rage for bets on fix and flip multifamily, which became the hottest asset class since the pandemic. The problem, however, is that because they're floating rate, when interest rates spiked last year, a lot of property owners found themselves underwater and then default. Number 2, SOFR. The Secured Overnight Financing Rate, or SOFR, is a broad measure of the cost of borrowing cash collateralized by Treasury securities. It's quickly become the go-to rate for pricing variable interest loans, replacing another acronym you might be more familiar with, LIBOR, which was the London Interbank Offered Rate. LIBOR fell out of favor after it was found to be frequently manipulated by the big banks. So now when you hear of construction or acquisition loan rates, you'll often hear SOFR plus X, SOFR plus Y, etc. Number 3, CMBS. CMBS stands for Commercial Mortgage-Backed Securities, which became the go-to source of CRE financing just before the financial crisis. CMBS typically consists of pools of loans, often from different lenders, that are packaged together and then securitized. They're typically fixed-rate loans with terms ranging from 5 to 10 years, and the properties they're backed by tend to be commercial assets where the income is stabilized, i.e. you're not looking to jack up NOI in any way. You have what you have. After the crisis, CMBS standards became a lot tighter, and they were made much more rigid, so you saw less of those crazy loans that you were seeing in the glory days of 06 and 07. However, loan issuance this year has plummeted since interest rates jumped. As of mid-February, just over $4 billion of new CMBS had been issued, compared to nearly $30 billion in the same period last year. Number 4, FDIC. The Federal Deposit Insurance Corporation is a U.S. government corporation supplying deposit insurance to depositors in American banks. It burst back into the industry spotlight in March when FDIC regulators placed Silicon Valley Bank into receivership following a run on the bank's assets. It then took similar steps with New York-based key multifamily lender Signature Bank and its counterpart on the West Coast, First Republic Bank. The FDIC was created just after the Great Depression to restore trust in the American banking system, and it's sure been working overtime recently. That's kind of a rundown of the most important acronyms to know in commercial real estate today. WTF did we miss? Let us know in the comments below, and be sure to follow The Real Deal for more Paydirt breakdowns.